Hello and welcome. This is Business Incorporated on Channels Television. I am BC Adebayo. On today's program, Zimbabwe expects inflation to ease to 134% this year. Ghana seeks to raise $500 million in London royalty IPO. Plus, Libya reopens the last of its oil fields. Let's begin the show with intraday market numbers, which were mostly negative, except Nigeria's main index, which is up 0.14% at intraday. Elsewhere in the region, South Africa's JSE declined by 0.5%, while the EGX30 shaved off 0.87%. Kenya's main index closed positive on Friday. And in the Middle East, the major Gulf markets were also mostly negative, except the Abu Dhabi index, which rose 1.24%. On the flip side, though, Dubai's main index declined 0.5%, and Saudi Arabia's main index declined 0.18%, while the Qatari index was marginally lower at intraday at 0.01%. Let's turn now to Europe, where the markets were lower this morning as surging coronavirus cases throughout the continent weighed on sentiment, while SAP's plunge led a sharp decline for tech stocks. Well, Conrad Bussen joins us now live from the Frankfurt Stock Exchange to tell us more about these developing stories. Good afternoon, Conrad. It's good to see you again. It's been a while. But then rising corona infections in Europe are raising concerns among decision makers. Now, the German Chancellor Angela Merkel, in a meeting with regional politicians, said that the country is facing very, very difficult months, and she doesn't even have a good feeling about this. How concerned are economists and businesses right now about all of these?
Good afternoon, BC. Well, more and more economists on the markets are reducing their forecasts for the economy. For example, Angel Gurria, who's the chief economist of the OECD, the Organization for Economic Cooperation and Development. He says that this year's slump of the world's economy is likely to be larger than anticipated until now, and that the recovery expected for next year is likely going to be weaker. Here in Germany, the chief economist of the state-owned development bank KfW predicts that the economy in Germany will slow down to zero during the first quarter of 2021, and that we can expect a stagnation at best of the unemployment rate. Last but not least, we got an update of the IFO index of business climate here in Germany today. It slumped, and it slumped more than anticipated by market participants to 92.7 points. So clearly the concerns are back on the markets, and all this is also reflected in, as you said, a slump in share prices here in Europe today. The Frankfurt DAX this morning, immediately after trading started, dropped around about 3%, and that's where it is right now as well.
All right, Conrad, now let's talk about SAP. That's Germany's large software maker, which has caught its midterm targets for the second time this year. How surprising is this for the markets, as other tech firms have profited from a surge in online activity in recent months?
It's a very, very negative surprise for the markets. SAP, the company, has lost around about 1/5 of its value this Monday, 20%. As you said, many tech companies have seen an increase in demand during the corona pandemic. SAP, not so much. We shouldn't forget that SAP has a lot of large clients, large projects it's working on, and due to corona, in particular in those large projects, decision makers have decided to rather postpone them, to put them on the back burner, because they are not sure whether the investment is really worth it at the moment. Also, SAP has a lot of clients in the travel business. It also says that its travel software sales are likely not going to recover. And last but not least, also we shouldn't forget SAP keeps investing a lot of money in its business, and the CFO of the company says he's not willing to reduce the amount of investments in the business just for a short-term optimization of profit margins.
Now, let's take this piece of good news in Germany, and that's the fact that after many weeks of collective bargaining negotiations, workers in the public sector are getting a wage increase. The frontline workers in German hospitals also getting an extra bonus?
Yes, they are. The people, the nurses and other health staff working in the German public sector hospitals are getting a wage increase between 8.7 and 10%. Of course, this is a reward for the tough job they have been doing and they keep doing, mostly due to Corona, but also this indicates how badly paid many of those people have been in the German health sector for a very long time. The employers, the public sector bosses had to come up with new incentives in order to motivate the staff to stay in the sector and also in order to motivate new people to decide to go into those professions. We need more nurses, we need more health staff in Germany. The other public sector employees are getting also a wage increase of up to 4.5%. And that's also, I think, quite remarkable and worth mentioning, given that those decisions and those negotiations have been so difficult this year. Of course, as you know, it is probably the same in Nigeria. It's very difficult to predict what the tax income will be in the coming months and also in the coming years. So giving wage increases is a bit of a tough gamble.
I can imagine, Conrad. Thank you for this update, and we'll see you again tomorrow. Well, let's turn now to the UK, where Juliana Olayinka will be updating us on what's driving market performance at Intraday. Good afternoon, Juliana. Well, let's start with this one. That's a research by anti-poverty charity ActionAid International, which has accused big US tech companies, Facebook, Google and Microsoft, of avoiding up to £2.1 billion in tax to poorest countries. How did ActionAid come up with this data?
Good afternoon. Well, really what they did were looking at loopholes. Some of these loopholes, these massive tech companies have been climbing through it in Europe. And so they decided to have a look at what's going on in developer nations. And they believe it's much worse. What ActionAid, the charity, are urging on the international community, particularly the United Nations, to do is to try and form some sort of a global tax so that developing nations who, of course, use these tech companies can get the tax back that they deserve. I think there is lots of legal legislation at the moment that doesn't make it compulsory for lots of these tech giants to disclose just how much tax they're paying. But according to their research, the worst countries or the countries that are most affected by low tax payments are India, Indonesia, Brazil, Nigeria and Bangladesh. So they believe that all in all, it amounts to about $2.8 billion. And they say that this money should really be put towards, underfunded sectors like education, like healthcare, which have really crippled during the pandemic, or at least we've seen some of the devastation that a lack of funding can cause during the pandemic. And as these tech firms have made so much money, they think it should go in there. It's a pretty good story, unlikely to get the attention that it deserves. But ActionAid are putting a lot of pressure on the United Nations. So it'll be interesting to see just how that pans out.
And we'll keep our fingers crossed on that. And talking about the pandemic, once again, the impact of the coronavirus is rearing its ugly face. And this time, it's the global aerospace industry, which has endured its worst quarter ever with record low orders for new aircraft. What's the implication of this on the UK aerospace industry?
Well, not great. We've got tens of thousands of people that work in aerospace engineering and manufacturing. And according to The Guardian, who are pushing this story forward, about 12,000 jobs have already gone in various parts of the sector. It appears as if a lot of government funding and a lot of the main business headlines are focusing, quite rightly, I suppose, on the front-facing jobs. So we know that thousands of jobs have been going in tourism, hospitality and pilots and air staff, but it's behind the scenes that Unite Union don't think the government have been putting in enough attention to. And as you said, the numbers are plummeting for people who are buying new aircraft because, of course, the industry has been completely paralysed due to COVID-19. The third quarter was particularly bad. I believe they only had about 8 orders to build new aircrafts, in 13 orders in July and August, 0 orders in September. If you compare it to the same period last year, they had 159 orders, and there are more concerns that it could get worse. We have had a statement from Rhys McCarthy. He's Unite's national officer, and he is asking for the UK to put much more money into aerospace engineering and manufacturing to try and save as many jobs as possible. He wants the British government, Rishi Sunak in particular, to give the same level of support that we saw in Germany and France. Germany, of course, famously bailed out Lufthansa for 8.2 billion euros, and we haven't really seen that here in Britain. Of course, Virgin Atlantic was sent packing when Sir Richard Branson went asking for their money, and there have been several other instances, including Flybe, which may be back up in the skies again next year. But again, as you said, it just goes to show that COVID-19, although we may not be in the peak of the virus, is still causing this bloodbath of job losses.
All right, just before you go, Juliana, what reactions are we getting from the equities and currencies markets at intraday?
Not much change on the FTSE at intraday. This morning I said that it was in the red. It did rise slightly at mid-morning because the Times newspaper here in Britain are reporting that the Bank of England is currently in some intense discussions with British banks about paying out a dividend again. And that's because in March, paying out dividends for banks was almost banned by the new governor, Andrew Bailey, because he wanted banks to focus on lending. But apparently that is all set to change. That pushed the FTSE 100 higher, but not enough to get it in the green. So at intraday, the all shares down 0.24%. The FTSE 100 is down 0.24%. And the FTSE 250 is down 0.12%. In currencies, the British pound up on the US dollar by 0.17%, up on the euro by 0.54%, and up on the Japanese yen by 0.27%. It's worth mentioning as well, Bissy, that of course lots of focus is on COVID-19. Over the weekend, Italy put up their highest restrictions that they have since the peak of the lockdown, and Spain has gone into a state of emergency. Still lots of talk here in the UK as well about whether Boris Johnson is going to scrap that 3-tier system and put England in a circuit breaker lockdown once and for all.
All right, thank you, Juliana. Do enjoy the rest of your day. And in Asia, stocks were mixed today as new coronavirus cases surged in the US as well as in countries across Europe. Mainland Chinese stocks were mixed, with the Shanghai Composite down 0.82%, while the Shenzhen Component added 0.47% to around 13,191.25. In Japan, the Nikkei 225 dipped fractionally to close at 23,494.34, while the Topix Index shared 0.39%, ending its trading day at 1,618.98. Over in South Korea, the Kospi declined 0.72%, while shares in Australia closed lower, with the S&P ASX 200 down 0.18% to 6,155.6. The Hong Kong market is closed today for a holiday. And futures tied to major U.S. equity benchmarks traded lower in early morning trade today as Wall Street headed for the last full trading week ahead of Election Day. Dow Jones Industrial Average futures were down 180 points. The S&P 500 futures and the Nasdaq 100 futures both also traded in negative territory. Now, the decline in the futures came amid a record surge in new coronavirus cases in the U.S., and the country saw more than 83,000 new infections on both Friday and Saturday after outbreaks in Sunbelt states, surpassing the previous record of roughly 77,300 cases set in July. Business Incorporated will be right back in just a moment. Please stay with us. Welcome back. The International Monetary Fund says despite an uncertain outlook, The potential of Sub-Saharan Africa and the resourcefulness of its people remain clear. According to the IMF, now is the time for lasting transformational reforms as policymakers in Sub-Saharan Africa face the added challenge of rekindling their economies with fewer resources and more difficult choices. But joining us now to drill down on the report is Matt Kinniger, an Associate Practice Lead at Sub-Saharan Africa in Dhaka Frontier. Good afternoon, Matt. Thank you for joining us on the program. Now, what are the major trends that stood out for you in the IMF's report on Sub-Saharan Africa?
Well, yes, it was quite an interesting report and also quite sobering to an extent. So one of the interesting trends that we are likely to see this year is a full-year recession of around about 3% for the entire region. However, there will be great variation between markets, with some markets contracting a lot steeper than that. And also very interesting to see the growth outlook. So the IMF is forecasting growth of 3.1% for the entire region in 2021, but again, quite significant variation. So some markets like Kenya, Cote d'Ivoire performing very well, whereas countries like South Africa not performing particularly well next year. Another major thing that stood out was per capita income levels are expected to fall back to 2013 levels, which is really quite a setback for the region overall.
Now, but given the dramatic economic shifts that are happening across Sub-Saharan Africa, how are multinational companies adjusting to this new environment?
Yes, I mean, it's a really interesting question because companies are really scrabbling to try to adapt to this environment. It's quite an unprecedented economic shock across the region. But there are four main things that companies appear to be doing and will probably do over the course of 2021. So it revolves around looking at their product portfolios in Africa to make sure that they are affordable and appealing to customers that have gone through a shock this year. Also looking at their market portfolios, focusing on the most resilient markets and also the markets that are growing the fastest next year, so potentially reallocating some resources to the fastest growing markets. Thinking about how they engage with customers. So we've seen a boom in digital engagement, a really sharp acceleration in digital engagement, either through e-commerce or through marketing, for example. So thinking about how companies can increase their digital engagement with customers is really important. And also how they work with their local partners. So many multinationals will need to support their local partners through this period of difficulty. And multinationals realize that actually investing more in skills development, for example, is going to be really important.
So what are the downside risks to Sub-Saharan Africa's growth outlook that companies should actually look out for in 2021?
Yes, so there is obviously a more upbeat view for 2021 for Sub-Saharan Africa. We are expecting the region to recover overall, but there are a number of downside risks that we are monitoring here at Dhaka Frontier. That includes debt. So we've seen public debt. We've seen Zambia default in its debt over the last few weeks. There's also a risk. That would result in much stronger or much quicker fiscal consolidation. So higher taxes, delays to infrastructure investment, for example, which could reduce demand. There's also a risk of a severe second wave. Well, we're already seeing this in Europe of coronavirus cases. But if it gets much worse throughout the winter in the Northern Hemisphere, that could reduce demand for tourism in Africa, but also exports from countries like Kenya and South Africa, very crucially. But also there is a risk around a deterioration in agriculture conditions. So last year was quite a difficult year for the region. We are expecting to see a recovery, which will support rural consumer demand especially. But if we do see another period of drought in East Africa or Southern Africa, or a repeat of the locust infestations that we saw, then that could affect economic growth quite substantially in 2021.
Associate Practice Lead, Sub-Saharan Africa, Dhaka Frontier, London, Matt Kinniger, thank you for speaking with us this afternoon.
Thank you.
Let's talk about Libya now. The country is set to restart the last of its oil fields closed in January, with the state energy firm lifting force majeure on exports from the major deposit of El Feel. According to the National Oil Corporation, crude production from the western field of El Feel, which will reach normal rates of around 70,000 barrels daily within a few days. The speed of the recovery has taken traders by surprise and put pressure on oil prices, which have been hammered since the coronavirus spread around the world. Zimbabwe expects its annual inflation to slow to 134% in 2020, more than half in the central bank's previous forecast. According to the Finance Ministry, the slowdown in inflation will be due to a deepening of the foreign currency auction market, which is expected to aid exchange rate stability. The ministry also says inflation will fall into single digits as the government continues to keep its deficit below 3% of the GDP. Zimbabwe is grappling with its worst economic crisis in more than a decade, with runaway inflation of 659.4% year-on-year in September and severe shortages of foreign currency, food and medicine. Ghana is looking to raise $500 million from the sale of up to 49% of gold royalty fund, Agapa royalties, on the London and Ghana stock exchanges. The West African country plans to complete the stock market flotation of its gold royalty company after elections in December, with the cash going to education, health, housing and infrastructure. Ghana has been struggling to deal with the economic impact of the COVID-19 pandemic. Its economy contracted for the first time in almost 4 decades in the second quarter of the year, and the government's growth stat is expected to reach 70% this year. The listing is currently on hold until Ghana's special prosecutor has completed a review to check if any elements of the deal, which will create the first Africa-focused minerals royalty company, were corrupt. And that's our program today. Thank you for watching. I am Bisi Adebayo.